Imagine a bubble so big that not even a supercomputer could track its own collapse. In October 2025, J.P. Morgan CEO Jamie Dimon issued a warning. The Bank of England followed. The IMF released a quiet statement. All said the same thing in carefully coded language. The AI bubble is real, and when it pops, the damage will be catastrophic. They called it valuation concerns. What they meant: we're watching the dot-com crash in slow motion, only this time with 10 times the capital and 100 times the hype. And like every bubble before it, nobody who's making money wants you to see it coming until it's far too late. Here's the math that should terrify you. In 2025, tech companies are projected to spend $364 billion on AI infrastructure, data centers, chips, cloud processing, and training models burning electricity like they own small nations. OpenAI alone pulled in $4.3 billion in revenue in the first half of this year. Impressive, right? Except they spent $2.5 billion just keeping the lights on during that same period. They're burning cash faster than they're earning it. And their plan to fix it? Raise their valuation to $1 trillion within 5 years. That's not a business model. That's a prayer wrapped in PowerPoint and decorated with blockchain metaphors. But here's what makes this different from every other bubble in history. Everyone knows it's a bubble, and they're investing anyway. Because in 2025, saying you were skeptical of AI is like saying you were skeptical of the internet in 1999. You get laughed out of the room. Pattern recognition dies when everyone's getting rich. That's the trap. The mechanism is identical to every financial mania on record, but this time it's dressed up in machine learning and chatbot demos that can write poetry. So let's pull back the curtain and see how this magic trick actually works. If that feeling in your gut says something's wrong, you're right. Now subscribe, because this channel exists to show you the pattern before it repeats itself for the millionth time. Every bubble follows the same script. We've seen it in tulips, railroads, radio stocks, dot-coms, and housing. This time they just changed the name to artificial intelligence. Rewind to 1999. The dot-com boom was unstoppable. Pets.com raised $82 million, spent it on a Super Bowl ad, and collapsed 9 months later. Webvan promised to revolutionize grocery delivery, burned through $800 million, and evaporated. eToys was worth $8 billion, at its peak then zero within 2 years. The pattern was obvious. Companies with no revenue, no profit, and no path to profitability were trading at valuations higher than century-old industrial giants. Investors didn't care. The narrative was simple: the internet changes everything, so traditional metrics don't apply. If you questioned that logic, you were called old-fashioned. Then in March 2000, the Nasdaq lost 78% of its value, and $5 trillion in market cap disappeared like it was never real. Because it wasn't. Fast forward to 2025, AI companies operate under the exact same delusion. Anthropic raised billions and burns cash at double the rate of typical startups. Stability: AI hemorrhaged $100 million annually, while generating a fraction of that in revenue. Dozens of AI startups are valued in the hundreds of millions despite losing money every quarter, because apparently, in 2025, AI no longer means artificial intelligence. It means asset inflation. The justification? The same one from 1999, this time it's different. AI will change everything, so normal rules don't apply. You've heard this song before. You just forgot how it ends. Want to know the tell? Nvidia. The chip company powering AI infrastructure saw its stock explode to over $130 per share in October 2025, riding the wave like a rocket. Analysts project it could hit $200 within a year. But here's the problem: Nvidia doesn't create AI. It sells the shovels. And in every gold rush, the shovel sellers get rich first and crash hardest when miners realize there's no gold. In the dot-com era, Cisco played the same role. It sold networking equipment, powering the internet boom. Its stock soared to $80, making it the most valuable company on earth for a shining moment. Then it collapsed to $8. Nvidia's valuation today has that same fragility. It has built on the assumption that AI companies will spend forever. But forever is a long time when you're burning billions. Here's where it gets darker. The spending isn't just unsustainable, it's irrational. Microsoft, Google, Amazon, and Meta combined are pouring $300 billion into AI capex in 2025 alone. Why? Because if they don't, their competitors will, and the narrative says whoever dominates AI dominates the future. So they're locked in mutually assured financial destruction disguised as innovation. Meanwhile, none of them can point to a product that justifies the investment. ChatGPT is impressive, but it's not profitable. Google's Bard generates headlines, but it hasn't generated sustainable revenue. The entire industry is betting that someone, somewhere, will figure out how to turn AI into actual money before the cash runs out. That's not strategy. That's a Ponzi scheme with better marketing. The parallels to 1999 don't stop at valuations. They extend to investor behavior. In the dot-com era, venture capitalists threw money at anyone with a website and a napkin sketch. Today, they're doing the same with anyone mentioning large language models in a pitch deck. Y Combinator, the prestigious startup accelerator, funded over 100 AI companies in 2024 alone. Most will fail. That's fine, failure is part of the game. But when an entire sector is built on the assumption that one of these 100 bets becomes the next Google, and 99 are designed to burn cash until they either exit or die, you're not investing in innovation. You're feeding a casino. And then there's OpenAI, the company everyone points to as proof AI is the future. Let's break down their actual numbers. $4.3 billion in revenue, $2.5 billion in operating costs. That leaves $1.8 billion in gross profit, except it doesn't, because that figure doesn't include the massive infrastructure they're building to scale. OpenAI projects, they need another $7 billion just to stay operational through 2026. They're not a profitable company. They're a black hole with a chatbot attached. Their survival depends entirely on convincing investors that someday, somehow, all this spending turns into self-sustaining profit. Maybe it will. History suggests it won't. But the real danger isn't that AI companies fail. The real danger is what happens when they do. In 2000, the dot-com crash wiped out $5 trillion and triggered a recession. That was bad. But it was contained. Most losses hit tech investors and venture funds. This time, the damage will be systemic. Because AI isn't just a sector anymore, it's embedded in everything. Pension funds are invested in Nvidia. Sovereign wealth funds are backing OpenAI. Retail investors are piling into AI ETFs without understanding what's inside them. When the bubble pops, it won't just hit Silicon Valley. It'll hit your retirement account, your bank, and the market indices your savings depend on. Here's the mechanism they don't want you to see. AI companies aren't valued on earnings. They're valued on narrative. The story goes, AI will replace jobs, revolutionize industries, and generate trillions in productivity gains. Therefore, any company positioned to capture even a fraction of that value is worth billions today. The problem? The story isn't true. AI automates tasks. It doesn't create new wealth. It redistributes it. And the jobs it replaces don't magically transform into new jobs elsewhere. They just disappear. Productivity gains don't get shared with workers. They get captured by shareholders. The entire valuation model is built on a fantasy that technological progress automatically translates into broad economic prosperity. It doesn't. It never has. But the people selling AI don't need you to understand that they just need you to believe the hype long enough for them to cash out. And they're cashing out. OpenAI's early investors, including Microsoft, are positioning for secondary market sales. Anthropic is in talks for another funding round, letting early backers exit. Nvidia insiders have sold billions in stock over the past year. The smart money isn't betting on AI's long-term success. They're betting they can sell before the music stops. That's the surest sign of a bubble. When the people building the thing start heading for exits, the foundation is already cracking. Want another parallel? The 2008 housing bubble? Banks knew the mortgages they were packaging into securities were garbage. They sold them anyway because commissions were too good to pass up. When the crash came, executives walked away with bonuses while taxpayers footed the bailout. This time, it's the same story with different names. AI companies know their models aren't profitable. They're selling the vision anyway because funding rounds are too lucrative to resist. And when this bubble bursts, the same thing will happen. Executives take their stock options and run, while pension funds and retail investors eat the losses. So what should you watch for? The warnings are already here. Jamie Dimon isn't issuing caution for entertainment. He's protecting JPMorgan's exposure. The Bank of England isn't publishing reports on AI risk because they're bored. They're seeing stress tests that genuinely scare them. The IMF doesn't warn about bubbles unless contagion is real. These aren't idle concerns. They're breadcrumbs from institutions that see the balance sheets you don't. When central bankers start using phrases like valuation risk, they're not speculating. They're preparing. Here's the pattern every bubble follows. First, new technology emerges with real potential. Then hype takes over and valuations decouple from fundamentals. Skeptics get drowned out. Investors pile in, afraid of missing out. Then one company fails. Then another. Suddenly everyone realizes the emperor has no clothes. Panic selling begins. Markets crash, wealth evaporates. And the people who saw it coming are called prophets, while the people who bought at the top are called fools. We're somewhere between the hype phase and the reckoning. The crash hasn't started yet, but the fuse is lit, and nobody's putting it out. But wait, there's one chart that explains why the crash could be 10 times worse than 2000. The irony is that AI is real. Machine learning will change industries. Natural language processing has genuine applications. But that doesn't mean every company calling itself an AI firm deserves $1 billion valuation. The internet was real too, but pets still went to zero. Technology doesn't justify insanity. It just makes it easier to sell. So here's the takeaway. If your portfolio is heavy on AI stocks, you're not investing in the future. You're betting on a bubble that hasn't popped yet. If your retirement fund is loaded with tech ETFs, you're exposed to a sector priced for perfection and structured for collapse. And if you're hearing that AI is too big to fail, remember, they said the same thing about housing in 2007, about dot-coms in 1999, and about railroads in the 1840s. Nothing is too big to fail, especially when it's built on hype and held together with venture capital. The $500 billion AI trap isn't a conspiracy, it's a cycle. And you've seen it before, you just didn't recognize the costume. This time, the bubble wears algorithms and neural networks. But underneath, it's the same old story. People confusing narrative with value, mistaking spending for progress, and assuming that because something is new, the old rules don't apply. They do. They always do. Knowledge is the only hedge that never loses value. So stay skeptical, watch the patterns, and remember, when everyone's getting rich on the same idea, someone's about to get very, very poor. That someone might be you if you're not paying attention. This is money's hidden history. And history doesn't stop repeating just because we renamed the bubble and gave it artificial intelligence.